Hi, good evening, friends. Welcome to the uh, another episode, or you can say another analysis of a new stock uh, company. It's called International Conveyors Limited. I recently shared an update regarding an acquisition of 3,33,289 shares of IIFL Finance Limited. So it was procured at 333 rupees on the 13th of February. Thereafter, the trend of both the stocks, the International Conveyors Limited and the stock for IFL Finance, has also been on the downward trend. So this is down today. This is down since the last 5 days. This is the downtrend since the last 1 month. Overall, 25% down since the last 6 months. Overall, year to date is negative of 26%, all time negative of 13%. So it seems like company listed maybe a few years ago seems to have done very well. The value add, it's not a bad price to be buying this stock at. Let us look at how the performance has been and what sort of future can we expect, future trends and growth perspectives here. So this is the logo of the company. So this is a conveyor belt. So this is the primary business of the company. Some pictures for you to observe. This is another picture for you to observe. Another machinery product that you need to check and observe. Another one. Okay. Incorporated in 1973, engaged in the manufacture of conveyor belting. It's an ISO 9001 certified company, India's only listed player in the PVC conveyor belting, a critical consumable for high growth sectors like mining and bulk transportation of materials such as coals, potash and salt. So the company specializes in solid woven conveyor belting for both underground and above ground applications. Its in-house design team manages the entire process. Primarily, system designs involves power and tension calculations to detailed design. In addition to its core manufacturing, ICL also engages in trading of steel cord conveyor belts and fasteners. The company has a treasury segment that focuses on investments in equity instruments, intercorporate deposits, and mutual funds. So this is the reason why they bought IIFL Finance Limited shares as an investment perspective. So product for portfolio, range of products comprising type 3 to type 12 that are more suitable for meeting Indian requirements and international standards range from type 3 to type 18. So its company is one of the largest manufacturers of solid woven belting in the world and has a complete product range with the ability to make conveyors up to 3150 kNm. So not really sure what that means. It's a type width with 18 width in strength and belt widths up to 1800 mm. User industries: potash, phosphate, fertilizer, coal, cement, clay, gypsum. Then clients: Nutrien, Mosaic, Rosebud, Belt Service, Glencore, Peabody, Beltec, Viaco and Incham. Domestic: Shree Cement, SMS, SCCL, Tata Steel, JMS, Coal India. The company is associated with Mato Industries Limited UK as the distributor in India for Mato belt lacing machine, fasteners, spindle, pins, belt cutter, etc., and involved in numerous supply arrangements for the Indian coal mines. So uh, high entry barrier. So what the company is trying to say is the entry barrier due to dual stage approval process to be approved by a process to be an approved supplier. So that means it's a long process before any company would approve them as their supplier. So long-term contracts are awarded ranging from 5 to 7 years with approved suppliers to avoid long gestation and tedious process of approvals for vendor selection. So if the company is selected, at least they will get a 5 to 7 year contract, and it's difficult to get a contract. It can range between 1 to 2 years to actually get an approval for them to supply the belting products that they have. So company is engaged in wind power generation through 5 wind power turbines in the state of Karnataka, Maharashtra, Gujarat and Andhra Pradesh with an installed capacity of 109 lakh kilowatts. So company mainly exports to US and Canada. So market cap 401 crores, 63 is the current price, high of 111, lowest of 61. Stock P has come down today to 4.73, book value 52.5, dividend yield 1.7, ROC 23%, ROE 23%, face value of share 1 rupee. Company has delivered good profit growth 64% in the last 5 years. Company has maintained a healthy dividend of 26%. Has delivered poor sales growth of 9.38 in the last 5 years. Earnings include any other income of 112 crores. So this other income would be income from power generation or the income from the investments that the company does make. So that can be further looked into. Debtor days have increased from 43.4 to 56.3. The working capital days have increased from 229 to 365. So it's a burden on the company. The working capital has increased, and before it can actually get their money back or rotate the funds, it's going to take longer, and that impacts the bottom line of the company, indirectly impacting sales and also impacting the growth story of the company. So sales growth and overall the profitability will also go down. So moving on, these are some other companies, though it may not be exactly the same kind of business that these companies do, but they must be having some related products that they are in business. That is why this peer comparison done by this site based on certain different types of companies. So it ranges from a P of 5 for this company to 54, which is the highest amongst these companies. Then we look at the return on capital employed. Apart from the last two companies or last three companies, the other companies seem to be doing well. GRP 15, International Conveyors 24, TINA Rubber 33, Pix Transmission 23. So there seems to be good volume return on the capital that these top four companies can provide. However, we'll need to see the revenue and the financials for the last 2 3 years to see if there has been growth trends that can be worth looking as a point of investment in them. So sales, you can see sales have reduced in the last quarter. Uh, Operating profit had gone up, but this quarter there is no profit. Companies having a net profit still of 20 because of the other income factor that it has. It's getting income from other sources and possibly from investments and stuff like that. So that is the reason why the company still made some profit, and the earnings per share is 3 rupees per share, which is amazing. I believe, though it has come down, but if the company is able to get more business and there is growth, there is a chance that the company will do well again. So this is the overall uh, last 2 years. You can see the sales have dropped, and this is a cause of concern. The company would have to look into see what has happened, what is the big chunk, which customer has backed out, which is causing the dent in the company. So this is another graph that you can have a look. Stock price has reduced by 34% over the last 1 year. Return on equity is still good. Compounded profit growth is 32% overall. This this for the last 12 months, and overall last 3 years is 52%, primarily due to the returns made in FY22 and FY23. You can see the last bit, uh, compounded sales growth, negative of 21% in the last 1 year and a negative of 8% in the last 3 years. So moving on, equity capital 6 crores, reserves have increased, which is a good sign. Borrowings have decreased, which is also very good. Investments, the company has investments which have grown in the last 1 year, so it's another good sign. As long as the investments make a return, then it's worth it. Debtor days have gone up, which is a cause of concern. Inventory has gone up, cause of concern. Impacting the working capital days, another cause of concern. However, if you look at see the the return on capital employed has increased with inventory being higher, possibly a more value produced from the extra holding of these goods, possibly. We'll have to look which particular segment that is more profitable for the company, and probably the company has diverted its interest in there, but however they need to see it's impacting the overall sales, though profitability is more, but overall the bottom line is impacted by inefficient use of funds, I can say. Shareholding, I mean, public holding is 31%, again, could be a big value factor in volatility of the stock and the price. So, and this is another website, it gives some more information. Book value 58, cash is 2 crores 36 lakhs, debit 128 crore, debt. Promoter holding is same, sales growth is the same, profit growth is showing 111% growth. This is for FY24, guys. So this was already something of the past, not of the current. In this particular year, the company is not possibly making much of a profit. The profit has gone down rather. So this is a PE of 9.5 the customer had, I mean the company had last year in May 24. So these are more likely companies being in the same or similar kind of field with more similar kind of products. So you have Forbes market cap 394, Fluidomat 377, Sealmatic India 375, Mazda 463. So the the market cap is not very high. They are all small cap companies. Price is Revati equipment. The price is very high. Apart from that, the others, the price for Forbes and company is just 300. Mazda 229, Pradeep Metals 260. So it's not a very expensive buy. Let us see what is the uh, price book value. So the price book value also is not very expensive. The highest price to book value is 4.7 and 5, which means that it's not highly overpriced. Still, there is a good opportunity to look at some of these stocks if somebody is really keen in getting more details. You can see the price. Uh, some stocks are expensive. Shraddha Prime is available at 106. So you can have a look and see if that is something that is worth it for investment. You can look at this company that we are looking into, International Conveyors as well. Uh, Here you can see nothing really much to discuss here. So return on capital or return on equity. So most of the companies are giving good, decent return on equity. So something that can be considered as the market cap of this industry is not very high. Maybe limited amount of players are there, so maybe limited amount of business. We'll have to pick the right stock which may add value in the long run. So here again, return on capital employed, you can see 33%, MK Taps, Revati 38, Pradeep Metal 17, Fluidomat 31, 32. So good amount of returns that the company can provide. So something worth looking into, though price may be high for some of the products or the stocks, but at the end of the day, if they are giving a return of 30% and at the net 20-25% return on equity, it's a very good value. It's a part. This company is a part of the L Pro International, another stock which is 64 rupees. So maybe you can look at what this group company does as well. This is 63, the other one is 64. Sales, I mean, these figures we've already gone through them. Profit growth, return on equity, we've gone through all this, we've been through this. Uh, Healthy interest coverage ratio of 9, which is very good. Apart from that, as efficient cash conversion cycle. So, cash conversion cycle is also good, minus 0.15, which is not bad compared to the market value. Generating cash conversion or cash flow is good, so it's not a bad deal. We'll just quickly go through some write-up here. There were some points that I had figured out while preparing this information yesterday, so bear with me. Okay, so I've told you about the investment point. Yesterday the price was 68 when I made this write-up. Today it's gone down to 63. So big drop in one day. Face value is 1. Market cap is reduced today. Return is negative. Stock P of 5. Book value 58. So it's come down. Return on capital, we've gone through. Reserves I've discussed. We didn't discuss about reserves, but you can see 5 years reserves have more than doubled. So not a bad option. See, large volume of stock held. So I've already discussed that. Cash, we've discussed that. Cash flow ratio, yeah, this is not actually great. So the cash flow ratio and the efficient cash conversion is two different ratios. So the the price compared to the market cap of this company is high, as high as 33, should be around below 10. It seems that the there should be better options of investment rather than this company. The market cap is pretty high compared to its value that it generates. So there is a chance of further correction in this stock because uh, this business is small. It is in a niche market, difficult to get growth in the current peer industry. So even if the growth comes, it won't be very high. Maybe the sales of 20 crores can become 30 or maximum 40 crores, and that too it may take a few years to happen. It won't happen instantly unless the company diversifies into more large volume and more profitable business with great growth potential in some kind of similar accessories or the similar kind of field. It is highly unlikely that the company would be generating too much of profit. So investments part, not all the time that the company could generate profit. It may generate some profit from the other ventures that is into, but it seems like it won't be able to generate the kind of profit that the company would expect. It cannot jump or grow maybe to 300% in 1 or 2 years or 3 years. So that is something we'll have to check every quarter if you already invested in this company. So company also needs to look at other complementary businesses. We've already discussed this now. Strength, okay, that's all been looked into. We've been through all this. We've gone through some other information. So if you want to read through, I mean, we have all that information here that we went through earlier. So get better idea of where you stand. So there's some information that I did not cover in the video. However, you can see there it is a part of the write-up. You can read through it once I publish it on Facebook, and you can also view it on YouTube, where the description is provided as a write-up and under the description column. So guys, thank you for watching. Please share with your friends, family and associates. Comment if you like the video, and also comment if you'd like to suggest any changes or improvements in the content. Thank you once again. We'll connect tomorrow again with another video. Thank you.